In this exam, we're given some data on ExxonMobil historical prices from Yahoo Finance. We get the monthly data, get open, high, low, close, adjusted close, volume. We also have some market data, like market return, risk-free return, and the difference between the two. See, what do we have to do? Arithmetic average, monthly return, Sharpe ratio, geometric average return, and lots of other questions. So we're definitely going to need to calculate return on Exxon. So let's insert a couple of columns here so that we have a nice space, a little wider. And first, let's calculate the total return on Exxon. And for that, we need to use the adjusted close because that incorporates dividends that were paid to investors. We take the current value, subtract the previous value, divide by the previous value. And let's copy that all the way down. And we can check this. Well, in January, Exxon did very well, had a return of 24%. What is the arithmetic average of this? Well, we can easily calculate that. Average of all these numbers is 0.7% per month. What is the Sharpe ratio? Well, for Sharpe ratio, we're also going to need the average return on the risk-free asset, which is over here in column Q. That's a 0.1% per month. So Sharpe ratio is going to be the difference between return on Exxon minus the average return on the risk-free asset divided by standard deviation of the return on Exxon, which is over here. Oops, and we're gonna say yes. And that's a 0.6 roughly. What is the geometric average monthly return? So we could do this a number of ways. We could calculate 1 plus the raw return and use the geom_mean function. So let's try that. Geom_mean using all these cells. And that's, oh, and of course we have to subtract 1 because otherwise we're just getting the gross return rather than a raw return. So it's about 0.2. You could certainly add some decimal places to it. 0.18. We could also do it by taking the amount of money that we end with divided by the amount of money that we started with and raise that to teeth root where t here is 48 and subtract 1 from that, and that gives us the same value of 0.18. Fantastic. If I invested $100 at the beginning of February, how much money would I have at the end of January? Again, we could do this a number of ways. We could use the future value function. Money grows at the geometric average rate for 48 periods. So there's no payment. We invest $100, and by the end, we would have $108.85. We could do it another way. We could start with $100 here and then ask, well, if I start with $100 at the end of January, how much money will I have at the end of February? It would be $100 times 1 plus the return in February. We're going to have to change this into numbers. Let's do that. Let's change it into dollars. And we'll copy this all the way down and end with $108.85. Just the same thing we got using the FV function, future value function. What is the geometric average annual return? Again, we could do this a number of ways. We can take the gross 1 plus the geometric average monthly return and take it to 12th power because it's 12 months. So it compounds monthly. Subtract 1 gives us well, yes, gives us 2.14%. We could do it another way. We could do the money that we ended up with divided by the money that we started with. And now pretend that we just have 4 periods because we really do have just 4 years. So we take it to 4th root, subtract 1, and it gives us the same number. Okay. What is the price return? So return excluding dividends. Well, that's just a percent change in the price, on the closing price, rather than the adjusted closing price. And so that would be this column F minus over here divided by F4. And we're gonna copy that all the way down and take average. Let's do it excluding dividends. Sure, let's do average of this column and gives us 0.2% per month. So the price return is considerably lower than the total return. Exxon is a company that pays hefty dividends. And so we really need to look at the total return if you want to see what is the return on that investment rather than just the price return. Using this data, can we tell which month Exxon pays its dividends? Well, that should be apparent when the price return and total return are different. So let's calculate a column here. And let's take the total return minus the price return. Well, here it's 0. There's no difference, probably because they didn't pay any dividends in February. Let's copy that all the way down here and see, well, in March, it looks like they paid a dividend because the total return was much higher, was 1 percentage point higher than the price return. And they paid another dividend in June, and then in September, and then in December. So clearly those are the months in which Exxon pays its dividend. What is Exxon's beta? So we could also do this in a number of ways. Let's use the line est function. We know that in the first row, it gives us the coefficients. In the second row, it gives us the standard errors. In the upper left corner, it gives us beta, the slope coefficient, and alpha in the upper right corner. I'm going to highlight these 4 cells. We're going to start typing line est. What is the dependent variable? Dependent variable is the return on Exxon. The independent variable is the return on the overall market. And we want true because we want it to calculate intercept, and we want true because we want these additional regression statistics. We're going to close the parentheses, Control Shift Enter, and it should give us beta and alpha. We see beta is about 1.12. We could do this another way. We know that beta is just covariance between the return on Exxon and the return on the overall market, divided by the variance on the overall market, which is this column. And I can hit enter, and let's see how this is formatted. So let's make sure that it's just a number. It's 1.112. That is Exxon's beta using these 4 years of data. Exxon market cap is about 300 billion, and its debt is about 50 billion. What is its unlevered beta? It's just the levered beta multiplied by the share of the market value of equity in the sum of market value of equity and market value of debt, which is 0.96. So its unlevered beta is somewhat lower. According to CAPM, and given the above data, what is the expected monthly return on Exxon? So let me actually write CAPM using my handy annotations here. Let's use red. So CAPM is telling me that well, return on equity should be equal to the return on a risk-free asset plus the company's beta times the return on market minus the return on risk-free asset, where this thing here is the market risk premium. So we've got all these ingredients. So let's calculate that, and risk-free is over here, 0.1 plus beta 1.12 times, and then in parentheses, let's do the market return minus the risk-free return, and the expected monthly return on Exxon using this data is 1.36% per month. All right, fantastic. So next question, Exxon pays 4.25% on debt, has a 25% tax rate, and an analyst estimates its weighted average cost of capital at 7.5%. What does this imply is the analyst's estimate of the cost of equity? So we already have one cost of equity here that CAPM gave us, which is 1.36. Now here we're dealing with annual figures, and somewhat different approach, somewhat different angle. So let's see what the analyst is thinking for the cost of equity. Let's again use my annotations, and sure, I'm going to use yellow. And we know that let's make it red again. We know that weighted average cost of capital equals the share of equity, market value of equity, in the sum of market value of equity and debt times the cost of equity plus share of debt in the market value of equity and debt times the cost of debt after taxes. So the interest on debt times 1 minus the corporate tax rate. So we know all of these, most of these numbers. We know that this is 7.5%. We know this is 300 over 350 times the equity cost of capital plus 50 over 350 times 4.25% is the cost of debt times 1 minus 25% is the tax rate. So the only thing we don't know is the return on equity, or the equity cost of capital. And if we use some algebra, we'll see that it's going to be 7.5% minus this 50 over 350 times, actually, I'm not going to write it all out. Let me actually type it in so that we could see the numbers. So I'm going to X this out, and it's calculated here. So what we're looking for, I'm going to put it in parentheses, we're looking for 0.075, and from that we're going to subtract 50 divided by 350 times 0.0425 times 1 minus 0.25. And now the whole thing has to be multiplied, because we brought everything into that side. Now we have to multiply by 350 divided by 300, and that gives us 8.22% is what the analysts estimated cost of equity is. So in question 12, we're asked to reflect on that a little bit, because now we have two different kinds of cost of equity. We have this one here, which is 1.36 per month, which is equivalent to about 17. If you multiply this by 12, that's a pretty big number. And then we have this one, which is 8.22. So one big difference between these two is that this is per year and this is per month. But even if this was per year, it would amount to about 17% per year. Right? And 17% per year is a very different number than 8% per year. So how come the analysts' calculations imply 8%, and our data implies 17%? Well, we can examine what is the market risk premium in our 4 years of data. We see that it was about, let's actually take a look at it. X this out. It's about 1.1% per month. 1.1% per month is the market risk premium, which is pretty high, 1.1% per month. That's 1.1% per month is about 14% per year. And that's a very high market risk premium. I suspect that our analyst, when he or she calculated the equity cost of capital, did not use 14% as a market risk premium, but rather something more reasonable, something more typical, like between 6 and 7%, 6 and 8%, maybe even 5%. So that's probably one reason that these results differ. Okay, fantastic. Let me actually clear these drawings and X this out, and let's move on to the next question. What do you think would happen to Exxon's cost of equity if it borrowed 50 million to buy back shares? Again, here, this is a sort of a narrative answer rather than a calculation. If we increase leverage, we know that equity becomes more risky. When you have a high leverage, the debt holders, they collect their interest no matter what is the state of the economy. And the residual income for equity holders becomes much more volatile. So when equity becomes riskier, the cost of equity has to go up. This is essentially Modigliani-Miller proposition 2, that with leverage, the cost of equity or the required equity return goes up. Essentially, when you increase leverage, the beta is going to be higher. The beta is going to be higher, and then hence the expected return will also be higher, expected equity return. So on number 14, what would happen to Exxon's enterprise value? Well, we have Modigliani-Miller proposition 1, which says that capital structure does not matter. But of course, that assumes that there are no taxes. In this exam, I specifically say we've got 25% tax rate. And so with taxes, capital structure does matter. And in fact, Modigliani-Miller proposition 1 with corporate taxes tells us that the market value of the firm goes up the higher the leverage, because debt creates a tax shield, and that tax shield increases the market value of the firm, because interest payments are tax deductible. So earnings per share after taxes are higher when you have more debt. Okay, fantastic. Another way to think about actually question 14, we know that under taxes with leverage, weighted average cost of capital goes down. And if nothing else happened to the business, discounting the business's cash flow at a lower discount rate increases its market value. Speaking of market value, let's calculate the market value of Exxon, given some assumptions about its cash flow and growth. We're assuming that we're going to be discounting at the 7.5%. There's a free cash flow this year of 30 billion. We expect it to grow at 2% per year indefinitely. So what is the value of that company? This is just like when we did a discounted cash flow model, except here we don't have to make any projections for year 1, 2, or 3. We essentially jump right into the terminal value, because we think that from now on things are going to be constant. So the enterprise value will be essentially the terminal value, which is 30 billion times 1 plus the growth rate of 0.02 divided by the difference between the discount rate, which is 0.075 minus 0.02 minus the growth rate, and that gives us present value of all those future cash flows is 556 billion. Of course, enterprise value, some of that cash flow has to go to debt holders, and so we know that market value of debt is about 50. And we assume that there's no cash, so that's net debt. So the implied equity value is the enterprise value minus debt is about 506 billion. How many shares outstanding? Well, we know that the current market cap is 300 billion, and we know that the current share price is 75. So that makes it about 4 billion shares outstanding, which means that the fair price or estimated price for Exxon should be the value of equity divided by shares outstanding, about $128 per share, which is considerably higher than its current stock price of 75. So according to this model, Exxon is pretty undervalued. And that's the exam.